when authorities try to steer the economy, to boost it in a slump or cool it when overheating, they use two main sets of tools. These are monetary policy and fiscal policy, and knowing the difference is key to understanding economic management. Monetary policy is action taken by a country's central bank to influence the economy, mainly by adjusting interest rates and the supply of money. By lowering interest rates or increasing the money available, a central bank can encourage borrowing and spending to stimulate a weak economy. By raising rates or tightening money, it can slow activity and fight high inflation. Monetary policy works largely through the cost and availability of money and credit. Fiscal policy is action taken by the government using its budget, that is, through spending and taxation. By spending more or cutting taxes, a government can put more money into the economy and boost demand, which can help in a downturn. By spending less or raising taxes, it can take money out and cool things down. Fiscal policy works through the government's own spending and the taxes it collects. So the essential distinction is who acts and how. Monetary policy is run by the central bank, working through interest rates and money. Fiscal policy is run by the government, working through spending and taxes. For example, facing a downturn, a central bank cuts interest rates, monetary policy, while the government boosts spending and cuts taxes, fiscal policy, two different levers pulling in the same direction. Economic conditions, policies, and measurements vary from one country to another, and they change over time. Economists themselves disagree about causes and cures, so check what applies where you live. The main lesson is simple. Monetary policy is how central banks steer the economy through interest rates and the money supply, while fiscal policy is how governments steer it through spending and taxes, the two main tools for managing an economy.